This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.
Good Sunday morning. This is Bud Hettinger. Next on News Radio 93.1 WFLA, the longest-running radio show in Central Florida, Dollars and Cents, with my good friend Joel Garris from Nelson Financial Planning. You can call him at the office this week at 407-629-6477 to schedule your free consultation to discuss your retirement plans, or you can talk to him right now at 407-916-5400.
Good morning, ladies and gentlemen, and welcome to the program Dollars and Cents. My name is Joel Garris. You're listening to Dollars and Cents, and my goodness, here we are, a new station, 93.1 News Radio WFLA. So now we've been officially all over the dial over the course of the 30-plus years of this radio program. I think when my father-in-law, Jack Nelson, started it back all those many years ago, we were over on the AM dial predominantly, and then we were on FM, and then we were on the low end on the FM, and then we were on the high end. Now we're back 93.1 on the FM dial. Supposedly the signal is a little bit stronger, so that means our reach is a little bit better. So that is good. Despite the switch on the radio dial, the format of the programs is, of course, staying very much the same. It is, after all, a conversation about money. So we have a variety of topics on hand to cover over the course of the next hour, and we will tease a little bit of them. We're going to talk a little bit about stock buybacks and how much they have increased of late. And, well, first of all, we'll go through exactly what they are and how they contrast with a dividend payment and how that affects the value of your investment in a company. We'll also spend some time. The IRS clarified some of the pass-through rules involving who can get the lower tax rate on their business income. If you recall, the tax changes that occurred late in 2017 that apply to 2018 are one of their features was that there was a lower rate on small businesses, particularly pass-through or flow-through businesses. If you had, for example, an S-Corp or something like that, there was a lower tax rate that was going to apply. So the IRS has issued out some clarification, some instruction, and so we will talk about that on the program today. And then some common IRA mistakes are also on tap for the conversation. More than 4 in 10 households own an individual IRA. That means there's 50 million households in America that own an IRA, and we'll talk about some of the more common mistakes. But before we get to all of that, it's a new month. Here we are, September, and we're, I guess, getting into the back end of the year. Labor Day, which is, of course, tomorrow. Traditionally, the end of summer. Of course, that was traditionally true where I grew up in New England. Down here in Florida, it's more like a perma-summer, and then there's like sort of a spring, and then it turns into summer again. But, hey, that's why we all live down here, is because we do like the weather. Interestingly, as the calendar shows, you're actually approaching the better months, if you will, for the market, particularly the last quarter. If you look at the 3 months, October, November, December, they rank in terms of monthly performance as number 2, number 3, and number 5 in terms of average monthly performance. In other words, October, on average, is the second best month. And many people don't think of that because they think of Black Monday back in October of 1987, and they just generally think that October a tough month. It is, in fact, as the averages have it, the second best month of the year. November is the third best, and December is the fifth best if we look back over the course of the past 25 years. Those last 3 months, that last quarter, gained 5% on average over the course of the past 25 years. Interestingly, that performance in the last quarter, in fact, accounts for just over half of the performance for the entire calendar year. So let me say that one more time. So in that last 3 months, how important is the last quarter of the year? Well, the last quarter of the year accounts for over half of the return on average that you would have gotten if you go back over the course of the past 25 years. So certainly some interesting numbers there, particularly in the last quarter as we start to get closer and closer to that time period. Certainly you've heard about us talk a lot about IRAs in the past on this program. It never ceases to amaze me. No matter how many times you talk about it, you always kind of see folks making errors along the way. So we thought it would be good to hit some of those more frequent errors. We actually posted this article on the various social media channels, the Facebooks and Twitter and LinkedIn and all of those places where if you go to our website, which is nelsonfinancialplanning.com, so pretty straightforward website there, just the name of the company with a .com at the end, you'll see in the upper right-hand corner where there's just a bunch of icons. You can click on any of those icons. If you click on like the Facebook icon, then you will see these articles that we post, usually post about 1 or 2 a week. You can also go to all of those social media channels and listen to this radio program as a podcast, because what we do each week is we reconvert the program and put it up on those social media websites. So this article we did post here, I think last week or maybe the week before, talking a little bit about some of the more common IRA mistakes. And one of them we actually had a conversation about with somebody just this past week. And that is the notion that if you are still working, you do not need to take a required minimum distribution out of your 401k or profit sharing or 403b. Any of those types of defined contribution plans, you do not have a required minimum distribution that applies so long as you are still working. So if you're still working, planning on continuing to work, then you don't have to worry about the required minimum distribution. If, however, you roll it over to an IRA, then guess what? IRA, different rules. You've got a required minimum distribution on that IRA. So we're actually visiting with somebody this past week. We got into a conversation about this. When we get back from the break, I'll give you kind of the gist of that conversation and why it's important to know how those required minimum distribution rules apply, particularly if you are still working. We'll do that when we get back here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Hey, welcome back to the program, ladies and gentlemen. Dollars and Cents. This is Joel Garris of Nelson Financial Planning. You're listening to News Radio 93.1 WFLA. A new position on the dial for us. Same station, same studio, pretty much the same everything except for where we are on the dial. 93.1 WFLA. That's where you can find us. So before the break, we were talking a little bit about IRAs and common mistakes. Oftentimes, the required minimum distribution is a big mistake. People forget to take it. People forget to realize that they have to take a required minimum distribution off not just an IRA, but also any inherited IRA as well. Now, one of the common misconceptions is if I am still working, what do I do about my 401k, my profit sharing, my 403b, or similar defined contribution plan? Well, you don't have to take the required minimum distribution on that. But be careful, because if you were to roll it over to an IRA, then you would. So if you're working along and you're continuing to work and you're 71, 72, the last thing you want to do, even if your plan allows this, is to roll it over to an IRA, because it would trigger taxes, or it would trigger a required minimum distribution, and then you would have to report and pay taxes on that. So just had a conversation this past week about the importance of just kind of leaving it alone, even if the investment options aren't particularly great. Find the best of what's available in that 401k or 403b, and then just leave it there so that you do not increase your taxes unnecessarily by triggering a required minimum distribution. Required minimum distribution rules apply to IRAs if you are over 70 and a half. And remember, on that 70 and a half rule, it is April 1 following the year in which you turn 70 and a half. What that also means, and there's another common mistake, is that if you're pushing off or deferring into April 1 or up to April 1 of the following year, know that you actually will have to take 2 required minimum distributions that year. So you wind up doubling it up. There certainly are some reasons why you would want to do that, but there are others where you might not. Specifically, you might not want to double it up if that double income on the required minimum distribution pushes you into a higher tax bracket. So certainly something to look at. But know that if you're still working, then you, in fact, do not need to take it out of those qualified, those defined contribution plans like a 401k or a 403b. So make sure that you do not, if you are still working, make sure you don't just roll over the 401k. Often most 401k plans will provide for in-service withdrawal distributions. If you do that and roll it over to an IRA, you unnecessarily trigger required minimum distribution rules on that money. Another common misconception is that you have to take your required minimum distribution from each and every account. You do not. You have to add up the value of all of those accounts and calculate your required minimum distribution, but you do not need to take it proportionally from each and every account. You've got to calculate the total amount that you need and take it from any one of those accounts. So again, a little bit of strategy planning that you can engage in when you're doing your required minimum distribution, because that means that you are able to sort of pick and choose where you actually get your required minimum distribution from. The last one that we'll touch on today is the rollover rules. Now, rollover rules are different from trustee transfers. So let's get that on the table first. The trustee transfer is where the money does not go through your hands. The check is made payable directly to the IRA custodian, and that's fine. And you can do that however often you want. A rollover is when the money somehow, some way, between one retirement account and the next one sort of flows through your hands. And if that's the case, and this is something that the IRS is really starting to look at, if that's the case, you can only do one of those within a 12-month period of time. The other caveat to that, of course, is that if you do that, meaning you take the money personally, you've only got 60 days in which to put that into the other retirement account. Otherwise, it's going to be taxable. So be aware of the sort of the two pieces of this. Is it's not just 60 days, which is the old rule. That old rule still very much applies, whereby if you take the money, you've got 60 days to put it right back in. The additional rule that now applies on this is you can only do that once within a 12-month period of time. Otherwise, you will run afoul of the IRS. So just a lot of rules on these IRAs and a lot of rules on the other types of accounts like 401ks and 403bs that are quite prevalent out there. So just be aware of these rules. A lot of them start to get complex when you start talking the required minimum distribution. You do have flexibility on that in terms of where you can take it from, but you've got to take it across all. You've got to total it for all of the accounts. The only exception is if you're still working, you don't need, and this is your current 401k, not an old 401k from a previous employer that you just haven't rolled over. It's the current 401k, and that one you do not need to take a required distribution from. If you retire, though, that will trigger a required minimum distribution on that account. So let's say you're mid-year and you retire and you're 72 years of age, that would trigger for that year a required minimum distribution on that account. So be aware of that little nuance as well. It's not one of those things where you can just say, oh, well, I was still working, so at some point during the course of the year, so I don't need to take my required minimum distribution on my 401k. No, that's not how that works. If you stop working at any point, December 30th, okay, during the course of the year, that would trigger a required minimum distribution on that 401k account, assuming that you're over the age of 70 and a half. So again, some nuances, if you will, on that. Also be aware of the new additional rule on those rollovers where it's not just that you've got to do, have the money moved over within 60 days. It is, in fact, also you can only do that once per 12-month period of time. So some new rules on that, some old rules that sort of people keep forgetting as it relates to IRAs. Certainly one of those things where you want to be careful about how you are approaching that. When we get back, we will continue the conversation here on the program. We will shift gears and we'll talk a little bit about stock buybacks and how those compare and contrast with dividends here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Hey, welcome back to the program, ladies and gentlemen. Dollars and Cents here on the new News Radio 93.1. Talking a little bit in this segment about stock buybacks, and certainly you're hearing an awful lot about them, particularly in today's world. It seems like a lot of companies out there are doing it, and that's if you're wondering, my goodness, it just seems like that happens much more. Then that perception would absolutely be correct, particularly when you look at the stats over the course of the past 10 years of the companies in the S&P 500 index, so that's 500 companies, a total of 466. That's a huge, I mean, in a 10-year period of time, you had nearly all of the companies doing some form of a share buyback. A total of $4 trillion to shareholders as stock buybacks, equal to 53% of profits. That number pales, the dividend number, the dividend distribution number pales in comparison. That was only $3.1 trillion. So if you think of owning large blue chip companies, you think, oh, it's the dividends, and that helps to generate out some additional income, and it certainly does, and we love that approach. The reality is that the bigger share of money distributed from companies over the course of the past 10 years has in fact been as a buyback. So let's talk a little bit about how that works. If I am a company and I'm doing a share buyback, then basically I'm going into the market and I am buying using profit that this company has made and going into the market and buying up the shares at whatever price they are. Now, why would a company do that, and how does that benefit shareholders? Well, here's how that works. Let's do a simple example. Let's say company ABC has 1,000 shares outstanding. All right? So each person that owns 1,000 shares, and I'm actually going to make it easy, do my math a little bit easier. We'll say 100 shares outstanding, okay? So each person that owns a share of ABC Company basically owns 1% of ABC Company, okay? 100 shares outstanding. ABC has a great year. It has a big profit, and it goes into the market, and it buys back 10 shares that were outstanding, okay? Now, there's only 90 shares outstanding. So instead of owning 1% for a single shareholder, now that same shareholder that owns one share owns basically 1.1% of that company, okay? So what happens on a stock buyback is it reduces the number of shares outstanding, which means that if I still own one share after the buyback, then that share is more valuable because that share represents a slightly larger percentage ownership of the company. Let me roll through that one more time. ABC Company, it has 100 shares outstanding. 100 different shareholders, everybody owning one share. ABC decides to engage in a buyback program and ultimately goes into the market to buy and buys 10 of those 100 outstanding shares. Now, for the 90 shares that are still outstanding, those 90 shares represent a 1.1% interest in the company, whereby before, when there were 100 shares outstanding, it was only a 1% share interest in that company. So you see how that works? When a buyback happens, less shares outstanding, making the remaining shares more valuable. And here's why companies do those stock buybacks rather than dividends, because a dividend you sort of have to commit to. And the stock market never likes when somebody says, okay, here's going to be our dividends, 15 cents a share, 10 cents a share, and then they have to change their mind on it at a later date. That disproportionately affects the price of that company's stock if they're constantly having to ebb and flow and change their dividend. When people own a stock and like to collect that dividend, they like that dividend to be very consistent. And when that dividend is inconsistent, then that's when shareholders don't like it, and then that affects the performance of that company's stock in the marketplace. So what the buybacks allow a company to do is they allow them to have flexibility to be able to use their profits. Oh, we had a great year. We've got a lot of extra profit. We don't necessarily want to declare a dividend because that means we got to commit to it. But let's do something for our shareholders to help improve their value. Let's go into the market and do a stock buyback. And what's interesting is there's been an awful lot more money spent by companies as stock buybacks than dividends over the course of the past 10 years. As we were saying, $4 trillion of stock buybacks, $3.1 trillion of dividends. So you can start to see how important these buybacks really are. Nearly all 466 of the 500 companies in the S&P 500 have done some form of a stock buyback, representing more or a greater portion of the total profit of a company. So there's certainly a fascinating change, if you will, in terms of how companies are run. Certainly a stock buyback gives a company an awful lot more flexibility to be able to do stuff with its profit rather than having to commit over time or longer term to a higher dividend payout. So it is fascinating, though. I mean, obviously, with all the conversation about stock buybacks in the marketplace these days, it is fascinating when you start to look at the numbers, just how big of a part they are of improving shareholder value and how much flexibility they give a company to be able to say, okay, we're going to do a stock buyback for this quarter, but we don't have to repeat that next quarter. We don't have to repeat that next year, as opposed to a dividend where generally it's a good idea to be very consistent on that dividend. So some interesting numbers on stock buybacks and how much they have become a part of how companies operate. You've got nearly all of the companies in the S&P 500 engaging in some form of a stock buyback over the course of the past 10 years. And nowadays, looking at those past 10 years, stock buybacks amounting to $4 trillion, whereby dividends amounting to just over $3 trillion. So stock buybacks have become much more of a way for a company to improve shareholder value. So some interesting stuff and statistics on stock buybacks. Hopefully that gave you a little bit more of an insight as to exactly how that all works. So the next time you hear about a company doing a stock buyback, hopefully that will all make a little bit more sense. We'll slide to the break. When we get back from the break, we will attempt to explain the IRS. Wish us well on that, but they've issued out some additional disclosures or additional explanation as to how the pass-through tax rate is actually going to work for this year. It'll be the first year that we've seen it here in 2018. So they're trying to clarify exactly how it works. So stay tuned for that here on Dollars and Cents with Joel Garris of Nelson Financial Planning on News Radio 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Hey, welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio 93.1 WFLA. Boy, I'm perfect so far in getting the new call letters out. So for the suits, as Jack used to describe them, for the suits in the studio and that are the muckety mucks, the execs at well, it used to be Clear Channel, but now it's iHeartRadio. Okay, we are perfect for not messing up the call numbers of where we are now at. I was briefed before the program as to what the change and how the change needed to happen. You'll notice that they've already recut the intros that Bud does onto the program, and so it's News Radio 93.1 WFLA. So exciting stuff. We've now officially been all over the dial in the 30 years of this program. Speaking of being all over the map, let's talk about the IRS. They're sort of can be all over the map these days, particularly given the complexity of the tax code, somewhat simplified with those tax changes that we saw at the end of 2017, particularly if you spend a lot of your time trying to figure out your itemized deductions. If you're adding up your charity, you're adding up your medical, you're adding up your trips to Goodwill, you're adding up your sales tax, all of that becomes much less of a point to do, because when you look at the much higher standard deduction, most of the people that were itemizing will simply be better off by claiming the larger standard deduction amount. Matter of fact, of the 30% of taxpayers who do itemize in the past, it's estimated that in that 30%, approximately only 20% of that 30% will wind up itemizing. So for the vast majority of people that were itemizing, that were spending time figuring out all of their stuff, their medical and their charity and their tax, there's really no need to do that because the standard deduction is going to be much bigger. So you want to be claiming the standard deduction anyway. A good rule of thumb, and obviously we'll talk a lot more about this when we get to tax time. A good rule of thumb is to sort of look at where you were last year for your itemized deductions. If you're close to 22, 23,000, okay, maybe you do want to kind of run the exercise for this year to see whether you're going to be above that new standard deduction or not. Or if you had something that was sort of a one-time transaction, maybe a one-time higher medical bills or dental bills, or maybe a one-time contribution to charity, that could have also, kind of pushed you above that new standard deduction amount. But absent that, if you look at last year's returns and you only had $17,000 or $18,000 of itemized expenses and nothing really much changed, it's probably not worth your time and effort and energy to do the exercise because the standard deduction will be much higher. Now, one of the other big changes with the 2017 tax changes that come into effect for 2018. So nobody's done a tax return yet with these new changes, and that is the ability of business owners to deduct 20% of their qualified business income. Now, what on earth is qualified business income? That's what the IRS is trying to explain. The deduction for that qualified business income is got to be obviously a domestic, a U.S.-based business operated as a sole proprietorship or through a partnership or an S corporation or even a trust and estate. For taxpayers with taxable income that is more than $315,000 for a married couple filing a joint return, the deduction starts to get limited. And here's where a lot of the information of late from the IRS is trying to explain the limitations and how they play out. So here's the limitations that come into effect with the ability to deduct up to that 20% of qualified business income. The type of trade that it is, the type of business that it is, comes into play. Your total taxable income comes into play. The amount of W-2 wages that was paid to you through that trade or business also comes into play. And all of those factors obviously muddy the waters pretty good when it comes time to try and figure it out. Now, notice I have not said anything about a C corporation. C corporations are not eligible for this deduction of qualified business income. That does not apply. So, when you're looking at all of the factors that come into play, one of the additional guidance that the IRS has issued is many real estate and insurance folks assumed they would be explicitly excluded from the ability to take this deduction above that income level. The IRS's recent guidance seems to bring that back into play, whereby if you're in the real estate business or the insurance business, then you may very well still be able to take the deduction. Where the confusion comes in is the original rules talked about brokerage services, and obviously not just financial people are in that business, but so too are real estate brokers and insurance brokers. It looks like the proposed regulations limit the definition of brokerage to just securities brokerage. So that's great news for folks in the real estate business or folks in the insurance business, whereby the original thought was that you may very well be picked up and excluded from being able to take this deduction. They have now limited the definition of brokerage to securities brokerage, which I guess that's bad news for me, but good news for folks that are in the real estate or insurance business. So those are some of the many things that they are starting to clarify. We're going to see and hear a lot more of that over the next few months, because they do have to get out a lot of proposals and rules to help clarify exactly what and how these rules are going to apply. This deduction for qualified business interest and qualified business income is very unique. It's brand new, and it's going to be the subject of a lot of questions, particularly for folks that have their own business, whether it's a sole proprietorship or you own it through a partnership or an S corporation. You're going to want to certainly be able to take advantage of this, because this allows you a deduction up to 20% of that qualified business income. If your income is high, meaning married couple above $315,000 or singles above $157,000 and change, then that's where you have to turn to all of these other things. Well, what type of business am I in? How much W-2 am I paying out from that business? What's my trade? What's my total taxable income? Those are the kinds of things that the IRS is beginning to spell out. But good news for folks in the real estate and insurance business, they appear to have been excluded out from the definition of the brokerage business, which would mean that they might very well be able to take advantage of this deduction. So good news for those folks, not good news for folks actually in the financial business, because you don't get the deduction anyway. But that's just the beginning of how that rule is going to be enforced. I would expect to see much more guidance on that and many other new tax rules for 2008. Obviously, we encourage you to continue to listen to the program, because certainly in the months and weeks ahead, we will have much more to say on that. But we got to get out of here, so I'll wrap it up. This is Joel Garris, Dollars and Cents on News Radio 93.1 WFLA.
This is Bud Hettinger, and you've been listening to Dollars and Cents with Joel Garris of Nelson Financial Planning. If you missed any part of today's show or want to listen to it again, check out the radio show at www.nelsonfinancialplanning.com or connect with them on Facebook or Twitter. Be sure to call Joel this week at 407-629-6477 to schedule your free consultation to discuss your retirement plan.